My name is Michael Metz. It's my pleasure to be your little MC tonight. I'm one of the board members here, and I'm really proud of this series. I just want to thank a few people for their efforts to make this happen. This is the third and sixth public sessions, lessons. I urge you to all to come to the other ones. They're in the website if you don't know the times, but they're Thursday nights. I want to thank John Anatucci, who is here somewhere. There he is from the Chamber, Launch VT. John really was instrumental, critical, really the core intellectual property in putting this together for us, creating some continuity into Launch VT. And we've really had great turnout, and it's lovely to see all of you tonight. I also want to introduce Dave Estes from People's United Bank. People's United Bank is the major sponsor here. We couldn't have done this without them. It was a fairly big gift within the total budget of this particular event. And it has really been, so far, a great event, a successful event, and I just want to make sure that we all give this good gentleman a little round of appreciation, and maybe you want to say a few words. So just hold that to your mouth.
I feel like I should sing a song or something with the mic. I'm not sure I need this, but so I'm Dave Estes, Senior Vice President and Commercial Lender at People's United Bank, and so welcome. And you know, we're so happy to be a part of something like this because you guys are our future borrowers. Maybe not today, that's okay, you know, future. And I'll tell you, at People's, you know, we have helped a lot of people over the years and be very successful. And so that's kind of where we get our enjoyment out of being able to kind of help all of you be successful. So welcome. We couldn't be more proud, more happy to sponsor something that will benefit all of you. So enjoy.
Thank you very much. So before I turn this over to John, I wanted to also thank our other sponsors. We did put a little list together to meet all our bills, and we were successful. But I want to first thank Davis and Hodgdon. They're presenting tonight. They're also, what would I call them, a signature sponsor for Generator this year. They're supporting a variety of different projects with us, an education outreach project, some work with their own folks. This program right here presenting tonight, so I really want to thank that gang tonight. I'd like to thank Merritt & Merritt Lawyers. They're the law firm in town I think is best known for helping businesses do their first initial offering. They're great people. Ken Merritt is a wonderful man. Small business, supporting this to a very significant level, and I want to thank them for that. I want to thank Fresh Tracks Capital. If you guys don't know them, they also provide financing for startups. They'll be speaking in a later session on finding money. Middlebury College, that has a really strong entrepreneurial effort going down to the college down there. We do have some interaction with them, and they've become a significant sponsor here. I'd like to thank M&E Designs. These are some of the early graduates of our organization, Generator. They moved out of here to start Alternator, a little accelerator up the street. And they're supporting this, and we thank them for that. We want to thank the Center for Women and Enterprise in Vermont. They did a couple of the sessions here, and they were collaborating with them on a variety of workforce development training activities. I'd like to thank BTV Ignite. This is the nonprofit that's involved in technology, developing the technology industry within Burlington. And I'd like to thank RETN, our media sponsors, who is putting this on television, allowing us to reproduce it on our website. And with that, I'm going to give this over to John, who I will thank again for your consistent persistence in this effort.
Awesome. So who's been to one of these before? Awesome. Who's been to both, the first two? Nice. And who's here for the first time? Okay, cool. So unfortunately, those of you who have been here before, you're going to have to hear the spiel because for the new people, I want to make sure they know there's some resources that are available to them. So I am the Director of Entrepreneurship at the Lake Champlain Chamber of Commerce, and the Chamber for the last 5 years has been running this great program called Launch VT, and it's expanded, and this is another example of a new program that we're expanding into to just try and help the people out here in our community who are trying to start businesses. And there's a million different types of businesses out there and a million different types of entrepreneurs, and we just want to try and make sure that we are creating services that are relevant and valuable to you. So the reason this program came about was because we thought, well, a lot of emphasis these days is being placed on big technology and like really growth stage companies and companies that can make lots of money and create lots of jobs, but those companies had to start somewhere. And what about the amazing physical products that are being developed and the new technologies that are being created every day by small makers and craftsmen who may, eventually grow their businesses and be very successful in the state. And so we want to make sure that we were giving them early on in their development process some business support so that they could make sure that they were, from the start, planning for their businesses so that they could be successful. So this series basically was developed with a few touch points along the way, and there's 2 anchor resources that go along with it. One is the business model canvas. So I encourage you, if you don't know what that is, to check it out. You can download it for free from the website. It's available on the Generator site, and you can just Google it and find it. The other is the launch report, and that is available on the LaunchVT website under our resources page. And they're just 2 tools. They're very different. The business model canvas is for brainstorming. The launch report is your finished product. So you throw the sticky notes up on the business model canvas, play around with it, test it, see what works. Once you think you've got something, put it on paper in the launch report, and now you've got this finished executive summary for your business that really forces you to commit to something, and now you can go out and you can apply to programs, you can apply for funding, you have a clear strategy to go out into the marketplace with. And so those are 2 of the resources we're using with the cohort, and I encourage those of you who are using this as sort of a full-on series and attending all the classes to utilize those resources as well. I want to give you 2 quick updates about LaunchVT. One is that next week on Thursday, on the 15th, we hold LaunchVT Collegiate. It is for college students who have businesses. So 6 schools from across the state. Students have pitched their ideas. They've won their business pitch competition at their school, and they're all coming to UVM on Thursday of next week, and you're all invited. It's free. There's food. It's a really fun time, and the winner of that will go on to join the official LaunchVT cohort and participate in that cohort this spring. So it's a really exciting event. Come on and check it out. So that's kind of it. LaunchVT couldn't be happier to be part of this wonderful community, and I'm just loving working with the entrepreneurs in our cohort and getting to meet all of you. So thank you all for coming out and supporting this, and keep going. It's a long journey, but the reward is there for those of you guys who are going to stick with it and persevere. So with that, I want to introduce our speakers tonight. This is not everyone's favorite topic. It's pretty much no one's favorite topic, and that's why everyone avoids doing it. It's part of the reason why I guess you guys are in business. But there's different kinds of support. There's the kinds that are really knowledgeable and know everything, and then there's the kinds that are knowledgeable and know everything, but they're really good at communicating it and helping you understand it so that you can take control of it. And that's what we have tonight here with Bret and Matt. So Davis and Hodgdon are leaders in the field of accounting, but they specialize in working with entrepreneurs. They also specialize in socially responsible business and in a bunch of other business services. The firm does a little bit of everything, but really I'm excited that they're here with you because they've worked with tons of entrepreneurs in small businesses, in large businesses, over their careers, and they have an amazing skill set and experiences, so they know what you've gone through. They've felt your pain, and they can deliver the information that you guys need in an accessible way. So just a little bit more about these guys. You should know that they are extremely distinguished. The number of acronyms that they have after their name is pretty daunting. I think collectively they have about 25 different letters. And some of the stuff that they do is completely beyond my understanding, like forensic accounting. I'm not sure exactly what that means, but I know that it's intense and it's hard to do, and it's a sought-after skill that not everyone has. So you're getting a very accomplished crew here. They're going to deliver a really nice presentation. It's going to give you some information that you can use. There's some nice formulas in here, some examples in here. So take notes, but we will be, again, putting this video up like all the other ones so you can check back, watch it again, review it, and there'll be, of course, as always, questions at the end. Time for questions at the end, so feel free to hit them with whatever you're thinking, whatever you need, because there's a lot of really rich stuff in the presentation they have tonight. So with that, I'm going to turn the mic over. So big warm welcome for Bret and Matt.
Thanks, John. I'm going to do a little bit of an introduction, and then I'm going to hand it off to Matt to lead us through the presentation. My name's Bret Hodgdon with Davis & Hodgdon Associates. I'm the partner in charge of the Williston office. We also have an office in Rutland, Vermont as well, and Matt's a supervisor at the firm. He's going to lead us on through some of the services. If you want to go back for me real quick, Matt. Lots of small business consulting, the regular tax, CPA work that you might expect, and we have a pretty strong bent towards QuickBooks and bookkeeping assistance that we do as well. So we've been doing this for a long time and have a fair amount of experience. As John suggested, we both have a fair amount of acronyms and letters, designations after our names, but we don't necessarily need to get into that. We both work with small business, tax, and consulting work. So we should be able to get you through the workshop pretty quickly, pretty efficiently. I'm going to turn over to Matt.
All right, can everybody hear me? I'm a total notorious mumbler. What we did tonight is we broke down the workshop into three kind of key sections that we're going to spend our time. One is your financials, which is everyone's favorite part of being in business. Cash flow is next, which is really more about understanding terms like cost structure and revenue streams. And then solutions and automation, which is kind of a look at really how you get started when it comes to accounting and forecasting and all that stuff you need to do. So we're going to throw a lot of terms at you tonight. We're going to define a lot of things. Probably heard them, maybe didn't entirely understand them. Before I get into that, I just want to throw something out there. Accrual basis accounting, and I just saw half the crowd glaze over. I promise you what I do is a lot easier than all of you think. It's how you think already. If I say assets and liabilities, a lot of people might not understand what I'm saying, but everyone in this room knows who owes them money, how much they owe them, who they owe money to, and that's really, in a nutshell, what accrual basis accounting is. Assets, that's the cash you have in your account. That's the amount that somebody owes you. That's the value of the computer that you had to buy to get into business. Liabilities, that's what you owe to your vendors. That's what you owe to the bank. That's what you're gonna owe next month that you already have received the services for and may not have been billed yet. Expenses are exactly what they sound like. That's the cost of operating the business. This doesn't get any more glamorous than that. Cash flow, which for most people just starting out is one of the more critical things to watch in a lot of this stuff, and that's just what's coming in versus what's going out. If you have a good handle on that, you're going to be okay. If you don't, you're going to be in trouble pretty quick. Bottom line, that's really kind of the what do you have at the end of the day after you've paid all your bills and received all you have, what's left over. Capital, which is a fancy way to say how are you going to pay for it all, especially out of the gate. There's two ways that you can raise capital. One, equity, that's what you've invested yourself. That's what other people have invested in you. And then the other is debt. That's what Dave Estes is invested in you from the bank. Accounts receivable, what do people owe you? It's that simple. Depreciation is a little bit more of a difficult concept, but that's, if you buy, say, a 3D printer, is that really an expense in the first year, or is that something you're going to get to use for 5 years? Depreciation is how you break that cost up over multiple periods and really get a better sense of what your bottom line actually looks like in a given year. Valuation. What is everything worth at the end of the day? You take up all your assets, back out all your liabilities, what do you have left over? Financial reports, and this is where we're going to next. There's three main financial reports, two of which we're going to focus on today, and they're the most important to understand as any entrepreneur. That's your balance sheet and your income statement, and then a cash flow statement is something that might be a little bit more advanced, but it's also pretty important to know when you're talking about what's coming in and what's going out.
The terminology here is really important, I think, and at our level, we tend to make assumptions more so than we probably should, but the terminology, I think, again, as Matt suggested, causes people to glaze over and shut down a little bit. So we wanted to start with the terminology and try to go slow and put it in terms that you would understand, because it's really not that complicated, and it's if you put it in everyday terms, and that's how we approached kind of starting off with some of the key terms. You'll see, and as we go through the rest of the slides, how there'll be more understanding of what they mean when you see them in context. So hold on for a little bit more if it felt like we zipped through that pretty quickly.
So section 1, your financials. So the first financial statement I want to talk about is probably the last financial statement most entrepreneurs think about, but probably one of the more important ones for you to have some sort of a handle on, and that is your balance sheet. In essence, your balance sheet is this equation: assets equal liabilities plus equity. What do you have that's worth something? What do people owe you? What do you owe other people? And then at the end of the day, if everything settles, what's essentially yours? The most important thing to remember about the balance sheet is if you understand everything on it, there aren't any surprises over on your income statement. This is a quick example of what a canned report you can get out of a system like QuickBooks, which we'll get into later. It's always organized this way, top to bottom. Up top, assets. You'll see examples of that are bank accounts, receivables, other various accrual basis assets, which a lot of you wouldn't worry about for some time anyway. Gets you to your total asset number. Liabilities and equities come next. It's always liabilities and then equity, which gets you to your bottom line number. If these two match, you know you've at least done that right.
That's why they call it a balance sheet.
Yep.
Balance sheet has to balance every time.
Yep. A little bit more on just specific things that equal assets and equal liabilities. There's really not a ton of mystery with these. I think we've covered most of them already, so I'm going to move on. Income statement. This is where people spend most of their time as entrepreneurs. It's really, what did you earn? What did it cost you? What do you have left at the end of the day? It's really, it can be both incredibly complicated and incredibly useful. I will say one common pitfall I see a lot of entrepreneurs getting in is creating an account or a category for every single possible thing that could ever happen. And you end up having an income statement that's this long. Keeping it simple isn't necessarily a bad thing. That's coming back to what I do is fairly simple. Your approach to tracking for things should be as simple as your business model requires. Again, this is an example. A lot of software packages out there have pretty good canned reports. To get a sense, again, top to bottom, you always start with income. Categorize as you see fit, where I might point here is 8937, probably not worth its own account. Comes down to something called the gross profit. So it's really, what did you sell? What was the cost of making what you sold? And then down below is all the other related costs to your business. What that's going to get you is net ordinary income, and then something essentially the same for most entrepreneurs, net income. This is kind of the section that captures everything else that doesn't quite fit above.
This is where most people live, our clients, and not just entrepreneurs. Most of our small business clients, up to millions of dollars of revenue even. A lot of those owners, much like you, this is where the rubber hits the road. What do I have for revenue and what are my expenses? Am I making any money? So this is where we focus an awful lot. And as Matt was alluding to earlier, it's not until this starts to turn positive that a lot of people start focusing on the balance sheet a little bit more, because that gives you a little bit of direction about where I'm going. Once this is positive, then the importance of the two statements together becomes more and more appropriate.
Dovetail on that perfectly, the relationship between the balance sheet and the income statement. What I alluded to earlier is that these two are intrinsically linked. You can't just look at one, and that is a trap a lot of people fall into. I'll show you in the next slide exactly how that math works out, but the idea being, if you understand everything on your balance sheet, you know that your profit and loss is correct. If you don't understand everything on your balance sheet, you've got an exposure there. Things can hide out in one different class of accounts that can potentially catch you off guard later on. So simply saying, your net income at the end of each year adds to your equity. The equity is really the summary of what you've banked in earnings over the period of your business's lifespan. Each year, this is an accounting entry that goes into, and essentially what it creates is, over here in retained earnings, that's the final score on how your business has performed over the course of its lifetime. Positive is good, negative not as good.
Can we just hold on for just 1 second? When we talk about the financial statements, some tips, some things I see about this when I have businesses come in or entrepreneurs come in and want to start a business, a lot of times they'll be, well, I got a loan or I bought a few things, what do I do with that? Or I'm just starting this year, but I've been accumulating things for a year, a couple of years, what do I do with that? And the tip is capture everything. Let an accountant help you when it comes tax time, but record everything. If you're putting money in personally to invest in the business, make sure you capture it. It doesn't matter if you're using, we'll get into it a little bit later, whether you're using Excel, a spreadsheet, handwritten notes, capture everything, because if you don't, you're kind of kidding yourself about what it's really costing you and what kind of, whether or not you really have a business there or not. If you're saying all this startup stuff, well, I'll start capturing that later once I actually start selling a product. Capture it all. It's all good data for you to decide and to make good business decisions on. So capture it all, and your accountant or the help of someone can help you. A tax preparer will help you sort it out about whether it's a deduction, whether it's not, what to do with it. But at the startup stage, the name of the game is capturing the data.
Section 2, cash flow, which we really should call cost structure. And this is the business model canvas that Joe was referring to earlier. Two of the key areas we're going to touch on down here are something called cost structure, something called revenue streams. Cost structure, if I have to boil it down into its kind of simplest possible terms, is really the service, or in most cases, if you're coming up through Generator, the product that you're going to be providing. How do the costs that go into making that, being able to provide that service or that product, what are they comprised of? And they're comprised of really two different categories of cost. One's variable, one's fixed. You can get really complicated really quickly here if you let yourself. And starting up, I like to tell people or coach people to think of it more of, next week in my business, what checks do I have to write if I sell 1 unit or if I sell 100 units? Those are your fixed costs for all intents and purposes. The next thing is, what are the supplies I would have to buy that would ramp up? What are the extra hours I would have to add to my payroll if things got really busy? Those costs that escalate with your sales, that's your variable portion of your cost. Those are two very important things to understand and have a pretty good firm grasp on coming out the gate if you're going to be successful in both planning your cash flow and understanding where your break-even point is in your business. Fixed costs, as I just said, they're fixed. There's no, you know what these costs are already. These are your rent. These are the salaries that you're going to have to pay. These are, to a certain extent, utilities. The costs to just be in business that are there regardless of whether you're busy or if you're not. Some examples of various costs or variable costs would be, again, wages, but more the, are you going to bring on extra help if things get really busy? Or is somebody going to go from 30 hours to 40 hours a week? Utilities to a certain extent, unless you're talking about a major manufacturing instance, you're not going to see much fluctuation there. And then the big one for most of you, I would wager, is going to be your materials, so your raw materials. Anything that you're manufacturing, what are the underlying components of that? And obviously those scale as you get busier and busier. Next, we're going to talk about revenue streams, which are really, I almost think the term is more complicated than the underlying concept. Revenue streams really are, how do you look at the different types of business that you have? Do you offer a service? Do you also offer a product? Do you have some other ways that you're getting cash that maybe aren't as formal or less frequent? Those are the things that you want to break down and evaluate separately when you're looking at how your individual revenue streams are performing and your business as a whole is performing. The example I'll give is if you do consulting but you also do manufacturing, you're going to want to be able to know what's the revenue from each, what are the related costs to each. That's where you decide whether something constitutes a separate revenue stream or if it's just lumped together. This is another area where you can make it really complicated. If you're a manufacturer and you've got 5 different types of projects or products that are all relatively the same, maybe you don't want to break those out, at least not out of the gate. Until there's kind of a meaningful grouping there, you want to keep this sort of where they're distinct and separate. The other thing I will say is, you know, when you're looking at your income statement, say you sell a piece of equipment. That's not something you want to just view as part of your sales. That's a one-time event. When it comes to whether it's regularly occurring, a regular line of business, or a one-time event, an active or passive activity, which is something either revenue that just comes to you, interest on your bank account versus something that you went out and earned, those are important distinctions you want to make when you're evaluating how you set up your chart of accounts and when you're looking at your results on your income statement.
For manufacturers, examples, to give a little bit of context, I have a few clients who have machine shops and they have scrap and they sell scrap once a month, and it's relatively lucrative to have scrap metal. Some of them are exotic metals. So that would be a revenue stream that's a nice little extra, but it's really not part of your business model. So that would be a revenue stream, but shouldn't contribute to your evaluation of whether the business is, your product is selling well or not.
Break even. This is why you really want to have a good grasp on what on your income statement is a fixed cost versus what is a variable cost. And the reason why it's important to know what your break even is it gives you a target to go for. Once you have this calculated, you know, I need to make and sell 100 units a week just to keep the lights on. This is your floor. If you don't go through the exercise of defining what's a fixed cost and what's a variable cost to you, you might as well throw a dart at a dartboard.
This is something that's used for mature businesses all the time. I have a couple of clients I go out and visit this time of year, and they make the comment to me, this is what I need to make in sales for a month, and then everything else goes to the bottom line. That's how they think of it. So I've got a client who, as soon as I do $20,000 in sales, I know I've covered my costs for the month, and everything else is just gravy. And it's a great way to look at it. It's a goal to shoot for. It's a good driver. And you know, and I go in and it's the first week of the month, and they've hit their 20,000. They're smiling, and it does a lot for morale around the place, knowing they know everything else is going in their pocket. So, or if it's not going in their pocket, then it's free cash flow they have to reinvest in the business, whether it's in growth or new equipment or whatever it is. So the break-even point here is very formulaic, but I think probably all of you to apply it, it will be much more intuitive and really base level. What have I got to do to make sure I cover my rent and what I know I've got to pay? It's X dollars in sales. It's nice to know that, and if you can knock that out in the first week, it's pretty rewarding.
What do you mean by price?
Well, I'll show you in this next slide, because we have this is kind of a key concept, so we've actually prepared an example that I'm going to walk you through now that's going to show you how to calculate a break even in a pretty simplistic looking business. So in this example, it's a manufacturer that makes a tool. They've gone through the calculations and they've identified that $60,000 for whatever period, let's call it a month, that's my fixed cost in this scenario. Looked at my rent, looked at my property taxes, look at my salaries that aren't going to fluctuate with production. It's $60,000 a month. The tool itself has a price, so that's the value to either wholesale or retail, so you can have different prices, of $2 a unit. And I know it's going to cost me 80 cents per unit to make the thing. That's the cost of the materials that go into it.
So that's variable cost, price, fixed cost, just to be clear.
So using a break-even calculation, your fixed cost divided by your sales price minus your variable cost, 50,000 units. It's that simple. And I know I'm oversimplifying something that you can spend a lot of time on, but I would urge you to, especially starting out, keep it simple.
Yeah, and this is units. A lot of times I would just give you the example of here's what I need to have in dollars. This can be converted. We know that a unit retails for $2, so it's $100,000 of sales is what they need. So whether it's units you think of or it's dollars you think of, you can do the math to say it's $100,000 in sales they need to break even.
It's the right answer, whatever you call it, but yeah.
Right.
Solutions and automation. There are literally hundreds of different packages out there for how you can keep your books and get started. And these days, there's actually quite a few different low cost or no cost to get started options out there to keep yourselves, your books in order. The things to consider, especially out of the gate, is you both don't want to get oversold, but you also want to make sure that you pick something that's going to be appropriate for what your longer term goals are. A lot of products might be good at just a certain level or a certain range in terms of the size of your business. To start, especially in a growth phase, you want to make sure that you get something that's cheap and does what you need now, but is going to be relatively upgradable to what you're going to need 2, 3, 4 years from now. These are just some examples of what you can find out there. Microsoft Excel is kind of the universal tool that goes with all of it. But beyond this, you can get lost out there on the internet pretty quickly trying to figure out how you're going to keep your books. The other thing you really want to focus on is what level of knowledge is required. And what I would say goes with that is what resources are out there to help you use the tool. A higher end ERP product probably has a lot of bells and whistles, but when it comes to support or web tutorials or online discussion forums, you might not find as much of a shared resource out there as you would a product like QuickBooks, which is relatively robust, but can be priced all the way from low to mid-market.
Yeah, a couple of things about the software. I have clients come in frequently who don't have anything, and they're comfortable in Excel, and I'm like, that's okay. I'm not going to push you out of Excel when it's a relatively simple business. What's most important, back to my previous comment, is tracking it. If you can be diligent using Excel and you're comfortable in it, I have had people come in that love pivot tables and they're Excel wizards. I'm fine with that. I can work with that. That's no problem. What's most important is, can you report out on it efficiently, and are you going to keep it up to date? Because it doesn't matter what you use, if you're not keeping it up to date and not devoting the appropriate amount of resources, which is your time or money, into keeping it current, it doesn't matter what you use. So again, early on, Excel can be fine. I don't think you need to jump to a package. But I think it does make sense, as Matt said, to get there pretty quickly. What I encourage people to do, a lot of times we do a lot with QuickBooks, but I've used Xero and Wave before too. I encourage folks to get the software, start using it when you have low volume of transactions, because then it's not overwhelming. I've seen it time and time again where people get it, they don't get comfortable with it, all of a sudden they have a flurry of activity and they get behind. And they're all of a sudden 6 or 8 or 10 months behind on entering and doing their books and doing their bank reconciliations and figuring out where they're at, and that takes another 6 months for them to get caught up. It's overwhelming when this isn't, you want to be doing what you do, not keeping the books. So I think that's the most important thing, is be disciplined, pick a system that you want to use, whether it's Excel or not, and be diligent about get into a routine in terms of recording the activity, so that as volume picks up, as it hopefully will, you won't be having to learn under all that pressure. It's just a few transactions a week, a few transactions a month, not a big burden. When it becomes 50, by the time it builds up to 50, it's old hat for you. So that's probably the best advice I can give. I have clients that have been in business for 20 years that this time of year I'm calling them up and they hit me with I'm through August, you know, in the next month I'll be caught up through the end of the year. And that's really not a great way to be running your business. So.
And they're still not caught up, by the way.
Right.
Some basic setup tips that we have. Organization is kind of the key when it comes to accounting. That's really more so than anything else. I would say we are professional organizers. Once you understand some of the basic terms, if you are an organized person at home, I promise you, you can keep a good set of books. One thing that in most accounting systems, obviously Excel isn't one, there's always an option for a sample company. Go in, play around, try things out. You can't mess anything up. It's a lot easier if you make mistakes playing around in a sample company than if you make mistakes and then we have to help you with it 3 months later, or 4 months later, 5 months later. One thing that we particularly like to push people towards is the idea of going paperless as soon as possible. There is no requirement that you have to keep paper copies of all the invoices and receipts that you have. You can scan those, and please do. You'll be happy you did. Your accountant will be happy you did. Everyone will be happy you did. I know we covered a lot here, but we wanted to make sure that we left enough time that we could take a good chunk of questions from the audience.
I'm supposed to run a microphone.
Oh, okay.
No.
I'm wondering if you can talk about what qualifies as significantly different, because I understand that, so I make jewelry, so I want to keep track of what I'm selling for taxes and all that, but I also want to keep track of what I'm selling for my own purposes so that, you know, if I'm making a pair of earrings that doesn't bring in money and I don't enjoy making anyways, I can just toss out the design and focus on something that does generate revenue that I enjoy making. That said, I know that if I get into the nitty-gritty details, it makes bookkeeping or, you know, finance tracking more complicated than it needs to be. So I guess I'm wondering if you could recommend sort of like, should I be keeping track of sales of product elsewhere? And then does that get complicated because I'm duplicating what I'm doing for financial reasons, or do you know what I'm trying to say?
If you are finding yourself keeping a separate ledger going in Excel or something else, you should probably be accounting for it, because you're duplicating efforts there. So in your specific example, I would say some ways that I instantly think about how I'd want to split it out. Do you have lines of jewelry that you price differently? It's one of a 40% markup, it's one of a 30% markup. Those might be things you want to consider looking at. How many of them are you making compared to the total portfolio of what you're offering? If it's something you would consider to be a significant amount, I would measure that separately. Where you can kill yourself is, you know, I made 5 of these last year and I'm creating a separate account for them. You already know what's going to be significant to you, and that's where you want to draw those lines. The temptation is you get a little overzealous with your accounts and you start dreaming up stuff that not just you're doing now, but you're going to be doing 6 months from now, and here's another idea that I had, and then suddenly you've got this monster. And you don't know what any of it means. So it's got to be meaningful to you when I talk about significant. Are you going to actually care that you can run a report that shows you what just that is, or are you just parsing your data to parse your data?
Thank you.
Blue, green, red are the same thing, probably not that relevant.
Yeah.
But if they're significantly different, yeah.
Yeah.
There's always the tricky part of like expecting the unexpected.
I'm sorry.
There's always a tricky thing about expecting the unexpected. So like when you're kind of like modeling, okay, so this is how much it's going to cost. Like, do you build a percentage in to be like, this is the things that you just can't account for, or how do you deal with that?
I always do that.
So what's that percentage number?
It's got to be reasonable. You can both talk yourself out of making good decisions by building too much of a cushion in, as well as make yourself blind to maybe some risks by being overly optimistic when you don't know. Identify as much of it as you can when it comes to cost. There's always going to be some component out there that you don't know, but again, a little bit of that's a gut factor. Typically when I'm doing any modeling, I'll build in a 5% to 10% reserve.
Sorry, I want to come over by the mic. I don't know if it's working. That's okay. I thought I have is track it. So learn from your own effort. So
Yeah.
pick an amount and track it and see how you did. So you establish your own baseline. That's really what's most important. And actually, it makes me think of a lot of clients and boards that I do presentations for. That how are we doing against our peers, and how are we doing against others? And I have learned from looking at this information that Vermont businesses don't oftentimes have a peer, like a close peer that they can model. There's always enough difference, whether it's facilities, whatever, product line is just different enough. The best tool you can do is start building your own baseline, starting to capture this data now and compare against yourself over time. That's really the best tool. And I know it may seem like a little bit of a cop-out of an answer, but it's going to be the best tool. Figure out, try a 10% buffer, see, and then just be sure to go back and measure it. If you just keep throwing 10% in there, 20%, whatever, then you might be making wrong decisions on a faulty assumption. So, I'd like to comment.
So I'm a local brick mason and stone mason, and every job I add a buffer to is based on sort of the job at hand and how large it is. Something that just came up this week, a job I did last year, a bluestone hearth on a fireplace just cracked. Now, that was a small job. I only veneered the fireplace with some tile and marble, put in a bluestone. It only took me a day's work. But I add a buffer in the event that next to heat, there's a possibility of something to crack. So I put a buffer in. I have to go back next week to pull that piece of bluestone out and replace it. I'm not going to lose money because I put that buffer in based on the percentage of risk.
Yeah.
Some other customers, I give myself about a year's guarantee. If my work falls apart in a year due to weather or the materials weren't right or something like that, I'll come back as many times as it takes. Being a tradesman, I'm also a salesperson. I read people. I know the clients that are going to call me every week and call me back to the job, and sometimes they're an hour's drive each way. So I have to buffer in a percentage that makes sense to fill my V8 pickup to drive down there and say, there actually is nothing wrong. I'll be back next week to tell you there's nothing wrong next week too. That's just cost measures. Sometimes you have to put a higher percentage based on the customers you're dealing with.
Yeah.
And
And
what you just said is exactly what I said. And he's proof that he learned from experience, that from working with these people, he's learned and said, okay, here's what my buffer needs to be and what's an appropriate buffer. So,
If I ever had to fix
Yeah.
it, I'd lose money every job.
right.
yeah.
Yep.
So I just had a question on like with tax season coming up. So this is my first year.
We're in it.
Yeah, yeah, well, we're in it. So I have an S corp, and I just like I don't even know where to start as far as I can't find any like all the information I find online is different on every website, and I want to figure out where to start. So any tips on just like where to start with that?
When did you form the corporation?
Last April.
Last April. And is this established business or?
I have no profits or losses at this point. Yeah, it's just been I basically just have the
You went
incorporation.
straight for the corp.
Yeah, I went straight. Yeah.
I mean, it's kind of, for those of you not familiar, we're talking about a legal entity choice that you get to make for your business. It's a little bit of a what I would call a higher end entity choice for a startup. It does mean that you have to file a separate return for the S corporation. It can add quite a bit of complication to the tax return, to the extent that the number of transactions, it can be a simpler S corp. To start, I don't know. To start, I guess it would help to dial in a response of where are you already and what are you wondering about specifically in terms of, I give you a prioritized list, but I'm assuming you've done your registrations, you've got something like your EIN,
Yeah.
you've registered with the Vermont Department of
Yeah,
Taxes.
that's
for
all.
sales
Yeah,
and-
because that's all up front. But so now, just being that the profits and losses flow through me and with an S corp, right? So
Yep.
I didn't have any for the first year, so it shouldn't really affect my tax. I just don't even know where to start. So
There'll be
it's kind
some.
of a specific question, but it's just like any tips in general on how to go about.
Find an accountant.
Okay.
Perfect. Yeah, because what you're describing is a situation that's going to be advanced for most people to do on their own. There aren't many people that have what would be a separate entity. So that's when you create a business that is something that's separately and distinct from yourself in the eyes of both the law and the IRS. So it files its own return. It has its own books. You get a little bit more complicated than an entrepreneur can handle on their own. So that would
That's
be
honestly good
the
advice.
best
Yeah.
advice I
Okay.
can get,
That's
yeah. Let me think about that.
Give it some thought.
Yeah.
How do you guys recommend people account for their time? Especially when
Yeah.
you're thinking about break even and
Yeah.
forecasting and all that.
I would say, that is definitely another trap where I've known entrepreneurs and I've known friends who get really excited about something they sold. And I made $500 on this. And I'm like, did you really? Because how long did that take you to do again? And you don't pay yourself anything, right? It's tricky because when you look at, especially as a startup, you are free labor, but you're not. You got to make a living too. And also, when you're evaluating what your break-even points are and how you price something, which should be both market-based and cost-based in terms of picking your pricing, you kind of got to look at it from the guise of, okay, if I were to hire somebody else to do this and I was to stand back as the manager, what would that cost me? Because eventually, if you get to the point where you're scaling, where your business is expanding, that's what's going to have to happen. And if you've priced yourself too low because you're used to being the free labor, you're really setting yourself up for either a steep increase or a rude awakening.
The short answer is pay yourself. Always plan to pay yourself. Even if you can't actually write the check, always pay yourself. So you're factoring that into costs. Even if you're internally building up a liability, what I owe me kind of thing, to help you do the math on this so that because you're in it to pay yourself. So that's like business startup kind of 101 is always pay yourself first. And I realize that you can't always pay yourself first, but that mentality will help drive you.
Keep a mental liability for it.
Right.
Got one along those lines.
Hang on, let me get you so you're on the.
So along those lines, paying yourself, I run an LLC, and at the end of the year, end of our season, we generally have a profit, and I cover some of my expenses and pay myself some with that. I've heard it's best to try to separate that and be very clear about it. Do you have any suggestions, like if it's a seasonal thing, end of the season salary, or do you try to break it up? Like I'm referring to separating liability in case anything happens with the LLC so that my assets are protected separately?
Yeah, I mean, we are teetering on the edge of what would be more legal advice than accounting advice. So with that kind of a disclaimer in mind, you don't want to take more out than is really there. When you talk about seasonality, that is, if you know your business really picks up in the winter, somehow attached to the snow economy, don't drain the bank accounts in January. Likewise, if your busy season is in the summer, make sure that you've got enough squirreled away to cover until it picks up again. Beyond that,
I have a couple of thoughts. It's a common question that I get when I have single member LLCs come in, and my spiel on that is always try to keep things separate as best you can. I understand that this is a small thing. Always have for the business, have a separate checking account in the business's name, and when you can, so don't commingle funds. If you want to pay yourself, write a check from the business, deposit it in your personal account. If you're paying a business expense and you happen to have money in your personal account, ideally write a check to the business, deposit it in the checking account, and pay the expense out of the business checking account. It just keeps the trail. To your point about separation, a separate entity, it keeps it cleaner. I understand that's hard when small businesses, whatever account's got the cash in it is the one I got to pay the bill from. I totally get it, but that's what you want to shoot for. If you're concerned with liability, you just want to do everything you can. From a legal perspective, I think the attorneys would say you need to be operating as if it's a standalone. If you're commingling everything and operating the business out of your personal checking account, it may jeopardize your legal standing and the whole purpose of an LLC. So try to keep them separate. I have clients a lot of times start up with credit cards, and so the business can't get their own credit card. A lot of people can. I try to say if you have two, most people have at least two. Pick one that you want to use only for business and use it only for business, so you don't have this split credit card thing. Use another one for your personal and keep it separated that way. Keep as much separate as you can and as reasonable possible. I understand there's going to be the occasional transaction when you're in a pinch, you need to write a check quick.
just to dovetail off that, another reason to keep everything separate is if you commingle things, it's going to be impossible to unravel where those costs go later on. Absolutely impossible. Yeah.
Quick little detail follow-up. everyone says write a check, but I don't go to the bank very often. Is a transfer of funds between accounts?
Yeah,
Yes.
yep,
All right,
same.
great.
Can you give some examples of how some of your clients habitualize the organization and tracking for all this stuff? So if I'm a small business owner and I have, direct to consumer online sales and wholesale accounts, and I go to fairs or markets and I go to the hardware store a couple of times a week, and what does it look like on a weekly or monthly basis to sort of be an organized person?
Yeah. So a lot of some of the clients I can think of that would be more closely parallel to what you're doing, they'll actually designate time. So they'll make a schedule. They'll say, Fridays from 12 to 1, I'm doing my books. I'm turning off the phone, putting away all my tools. I got my stack of invoices here. I'm going to get them all in. I'm going to get my payments out the door. That's where I've seen people be really successful, is by compartmentalizing their days you always make time for that part of your business. And the reason to be disciplined about it is it's the easiest thing to procrastinate. And then that stack of invoices, once it starts looking like this, or starts looking like this, I can tell you there's almost opposite likelihood that you're going to do anything about it at that particular time. Stay on top of it and be disciplined. Every Friday from 12 to 3, that's what I work on. If you can keep that schedule up, I've seen people completely doing everything 100% on their own, at least keep that piece in good standing.
A couple of thoughts to that, and some people like to leverage technology, and like I said before, do everything through their business debit card, because they can download it into a software package that will do the accounting for them, or at least do the heavy lifting in terms of key punching and that kind of thing. So that's a strategy I've seen be reasonably effective. I would say it gets people 80 or 90% of the way there without having to do much effort. And a lot of people don't use checks anymore. So a credit card, a debit card, and they're just really diligent about using that, and at least they capture that piece.
But finish the transaction. Do that last 10%, because again, that's something that can build up to an unmanaged.
Automatically downloads to QuickBooks.
Right.
Yep.
Right.
Depending on the solution you're using, you can fully automate most bank accounts and most credit cards with your accounting.
The other one, and the resources may not be there for it, but I had a gentleman come in the spring, and a single guy starting a business, and I happened to know where he was sharing space, and I had a bookkeeper who was helping another one of my clients there, and she's really good, and I said, I could train you, or maybe you could ask her if she'd spend, since she's there anyway, an hour a week doing your stuff. And she was more than happy to. She was there anyway. So sometimes if you're more passionate about what you do, and you can make money making a new piece of jewelry as opposed to spending that time doing your books, you may be able to make more money doing what you do than you can. So it's an option. Don't dismiss it totally that I could never have someone help me with that. That sometimes can be a good solution too. If you really don't want to do it, that's better than not doing it at all.
Yeah.
So I'm having a problem trying to figure out how to classify the payment gateway's transaction fee, because the payment goes from a website through Stripe to my QuickBooks. So by the time it hits QuickBooks, that never shows up anywhere. And the only thing I can think of is to manually enter it. But I didn't know if that's really truly the right way to handle that.
It's not necessarily the wrong way. I've seen clients do it both ways, where you show your revenue net of that merchant's fee, or you show it as a separate expense and you show the full amount of your fee. I lean towards the latter, just because it's good to have a handle on what that is costing you. Most of the time with these automations, which what we're talking about right now is a direct feed from a payment processor into your QuickBooks file, so that way you don't have to worry about manually inputting how much did I do in sales, how much did it cost me. A lot of times if you actually get into it, it's mapped a certain way. And what mapping means is you have, or a consultant who helped you set it up, told it to go there. So you can, a lot of times it's just a matter of going into the system and saying, nope, I don't want you to send this to my 4,000 revenue account. I want you to send this to my 4,005 merchant fee account. If that makes, and then you don't have to worry about doing anything manually, which is always kind of a win.
To validate your concern question, it's really common since before so many people were so easily able to do online things with Stripe and whatever else. Just regular credit card merchant servicing has always been really hard for businesses, often been because their fees weren't transparent. And MasterCard did it one way, Visa did it another way, and American Express did it a completely different way. So you would record a sale in your QuickBooks for $100 and American Express would deposit $95. I'm making it up. MasterCard would, on the same sale, would deposit $97. And how do you reconcile your bank account, right? You've got a sale that you recorded in your system for $100. You expect that's your receivable. And then when you apply what you actually gets deposited to your account, it mismatches. And so it's a real problem and it's a real frustration when the fee's not transparent. It makes it really hard to do your bank reconciliation and make sure you've got paid for everything you're supposed to get paid for. So it's a real issue. I'm more validating than solving your problem.
I was trying to solve it, but that's it.
I appreciate both.
Not so much a question, but just a little feedback for that. I know it's not the same for product transactions, but like we use QuickBooks for client services, and we use the payment processing. So what they do is a $100 transaction will come in as a $100 automatic profit. Revenue, but then they'll take off their transaction fee as an expense. So you can automatically do it. And I think Stripe and PayPal offer that within their settings to do that as well. They'll withdraw, they'll add, and then they'll withdraw. So that way it shows as two transactions.
Which is great.
I'm fairly certain on Stripe. I know PayPal does it, but I'm fairly certain on Stripe.
Yeah.
That's really good feedback. Thank you. And sometimes that's what we end up missing is not being on that side of it that much. We have limited experience, so that's really helpful.
Yeah.
Any other questions out there?
All right, Steve.
So someone launches into their own business and they don't like accounting much. When do you suggest they bring in some outside help?
It's got to support it. That's the thing is when you first launch your business, you are wearing every hat out the gate. Unless we're talking about a situation where you've developed some relationships, you've got either debt or equity coming in to help fund it. It's got to be to the point where the cost of the help can be supported by the sales of the operation. I would say if it's not your cup of tea and you're also the primary salesperson and that's where you really shine, the sooner the better. Don't hang on to things that don't make you happy and you don't need to do and aren't the highest and best use of your time. Those are the things you outsource the quickest, in my opinion.
I think that's a common mistake. I know that we're not selling legal services, but I see that I have attorney clients who are like, no, I don't want to pay you to do it, I'll do it. And I think to myself, at your billable rate, wouldn't you be better off going and generating the money to pay me and you'd still have money left over to do it? But I guess...
And be happier with the product that you're getting.
Right. I think that holds true. You know, if you can swing it financially and you can find someone at the right price to do it for you, and you can invest your time doing what you're good at, it's going to be a better investment of your time and money. So that was to my point earlier about if you're not good at it and you need to devote resources to keeping your financial health in good shape, and that may be resources that is your time or your money to make sure that they gets the resources devoted to it that is necessary.
Anyone else out there? Yes, sir.
Just kind of a random thing I've run across. Like I've run across many companies that have fiscal years that are not lined up with calendar years. Like, what is the advantage of that? Why do they do that?
That is a very good question. That is, for all of you, not a good idea. I'm just going to throw that in. I mean, it's kind of, there are reasons to do that. I would wager that no entrepreneur in this room has one of them.
You used to see it a lot more frequently. The IRS has kind of put in some stopgaps so that it's hard for flow-through entities to have fiscal years, so it's kind of like a C corporation is the only kind, and that's a little bit more advanced than probably you guys are at. But it was intended to capture cyclical natures of business, when a business cycle ends, so that you're not ending in the middle of a business cycle. That would be an advantage. A lot of people, like retail, for example, might be really busy around the holidays and into the new year, so they might have a January, February, March year end when things settle down, so that they can kind of take a tally and do their tax return from there. That's a practical reason of having an odd year end.
I've seen companies and nonprofits that are really heavily reliant on state contracts or state money, and so they'll have a fiscal year that mirrors the state's fiscal year. But again, it's going to be pretty rare that there's a persuasive reason, because it's a little bit more complicated to keep track of.
Any others out there? All right, well, listen, thank you very much. Good presentation. Thank you, Bret and Mark. Let's give a big hand for these guys.